Today we're going to be discussing the impact of information on investor behaviour and what clients can do to manage what are very normal human instincts when they're consuming information that might affect their long-term plans, which I know is a topic that's very close to your heart and you spend a lot of time talking about.
Absolutely, yeah.
So when we talk about investment information, what exactly is it that we're referring to?
Well, I'm sure people hear a lot that there's never been a better time to be an investor. We've got lots of choice. We've got lots of information around us. We've got lots of access to things like trading apps. But I would suggest that although these seem like positives, there's a lot of things that have evolved technologically speaking over the last 10 or 20 years for investors, which have become a real behavioural problem and have created more behavioural challenges for investors than they've ever had before. And a major part of that is just the sheer amount of information that we have to deal with. So we've got a 24-hour news cycle, we've got social media, we've just got a constant influx of news stories, data points about financial markets. And it's incredibly difficult to ignore that. And the temptation always is, when we see information, when we see new information about markets, is to act and make changes to our portfolio and to trade. And that's a very dangerous temptation to have to face on a daily or hourly basis.
That makes sense. What are some of the natural human behaviours that people might experience when they're receiving that influx of information that you talked about?
Well, I think human attention tends to be drawn to two things, and that's salience and availability. And salience is when we have some kind of emotional response to information. So it makes us feel something, it makes us feel worried or excited or anxious. So any of those feelings could be significant in terms of what our attention is drawn to. And the second part is availability. So we think about what we've seen right now, what's in front of our eyes right now, what's prominent in the news cycle. And we'll tend to overweight the influence of the thing that's right in front of our eyes and forget the thing that might be more relevant or that happened a year ago. There are two real implications of that. One is that we're just likely to neglect information that is genuinely important in favour of what we're currently feeling or experiencing. And second, again, we're just likely to trade too much, because what information is salient and emotive and available will change from week to week, from month to month. So there'll always be a new piece of information that's piquing our interest and our attention. So we get into the cycle of continually reacting to the next set of information, the next piece of market noise. And there's always a new narrative in markets for us to react to. And that can be really, really dangerous and damaging for our long-term investment objectives.
So when someone is reading a piece of information and they're starting to consider what it means for their investments or their financial plans, is there a perspective or a lens that they can look through when they're consuming that information that would be helpful?
Yeah, so I think there's two things that are really helpful, and there's two questions that we should always ask about information and financial information or things pertaining to our investments, and that is, does it matter? So given our long run objectives, let's assume most people have long run objectives for the investments they're making, does this piece of information actually matter? And most pieces of information over the long run don't really matter that much, and they matter much less than we think they do. And the second piece is it knowable or predictable? So it's one thing, even if we find a piece of information that we think matters, can we actually predict it or do anything about it? And if both of those things don't hold, then you really should be ignoring the information and not reacting to it.
That makes sense. Is there a good example of the problem with using current information to make investment decisions?
Yeah, it's interesting. There is, as I said, there's always a steady stream of new information, and what you'll find is people tend to talk and obsess about what is current, what is recent in markets, and generally what's performed well and what has performed badly. So I guess through 2023, we started the year with lots of analyst forecasts being quite pessimistic about equity markets, and equity markets through 2023 up till now have been pretty strong. So by the end of November, they've been strong across the year. And we've seen an interesting phenomenon where the returns from equity markets have been dominated by the 7 largest stocks in the US market, so the Magnificent Seven, as they're called, to these mega cap, mainly technology orientated companies like Google and Microsoft and an apple. And because again, this information is recent, it's salient, it has everyone asking questions like, well, what's the point in investing in anything else? These companies are going to be dominant going forward. They're going to be preeminent in generating returns in future years, not just for the 2023 or recent years past. That's really dangerous because you end up in a situation where you adapt your portfolio, you adapt your investment decision making for what's currently working, what's the current in vogue trend in markets. So you abandon diversification, you get rid of the things that haven't been working so well, and you just latch on to the latest narrative and what's been working in markets. Because all of the information we're seeing at the moment, all the narratives will be about the things that have worked best in the recent past. So it creates real decision making problems for us if we adjust our portfolio too much to react to the recent bout of information or the current news flow.
Have you got any anecdotes from either your own career or history in general where an overflow of market data or news has led investors to make poor choices or react impulsively?
Yeah, there's quite a lot of these. I think the best example, because there was major pieces of news or information, was in 2016, and this was the time where we had the Brexit vote and we had the US election subsequent to that, where Trump was elected when he ran against Hillary Clinton. And the interesting point about the 2016 example is there were two binary events. So we had Brexit and we had the EU referendum and we had the US election. And in both cases, market expectations were wrong about the outcome of those events. So the prevailing narrative, generally speaking, that we'd vote to stay in the EU and Hillary Clinton would win the US election, not Donald Trump. And obviously both of those predictions and forecasts were wrong. But it's not just that. It's the second point I think is even more important. It wasn't just that the predictions in broad terms were wrong, were incorrect. It's that the market reaction, so share price, bond price reaction to those events were also wrong. It also wrong-footed people. Their expectation was for market reactions to be in a certain direction if Brexit did happen and if Trump won the election, and to a greater or lesser extent, the opposite thing happened. So it just shows you how difficult it is. You're not only predicting certain events, certain outcomes, certain economic developments, you then have to forecast what the market reaction might be. And generally speaking, we're not very good at either of those things. So we have all this information around us. We're not particularly good at prioritizing what is generally important. And we're also not that great at predicting what the impact of that information will be.
And other things that people can do to manage these behaviours that we've discussed when they're consuming investment information?
Yeah, I think one of the counterintuitive things is it's a massive behavioural advantage if you can, to an extent, switch off from daily market news. I don't think there's any need for most people to be poring over what happened in financial markets on a day-to-day basis, and it's like to encourage some pretty poor behaviours. No one remembers what happened 2 weeks ago on a Friday in the financial markets, but we're still obsessing about what happened today, and we'll still worry about what happens tomorrow. So we just overweight what's happening right in front of our eyes. So if we can switch that off and ignore it, it will help us be more prudent long-term investors. The other thing is, it's really important just to define in advance what aspects are important and then attempt to ignore the rest. So when you're making a long-term investment plan, a long-term investment commitment, think about what matters to your investment approach, what factors are likely to be influential, and understand that most of the things that you come across, most of the things that you read about will be in the long run inconsequential. And if you look at any successful long run return in equity markets or balanced portfolio, they would have gone through just vast swathes of market information and events. And to generate those returns, you have to weather and navigate those events well, and trying to trade around them, trying to predict them in advance is a likely route to disappointment in my view.
And you talked there about navigating that news. Why do you think taking financial advice before you make investment decisions based on news or information that you've seen is so important in navigating that noise?
So I see financial advice as a behavioural counsel for clients. having someone to explain what matters, to explain your objectives, and also to explain expectations about the realities of making a long-term investment and what you'll need to withstand, what you'll need to experience. And any long-term investment, you'll go through periods of euphoria, you'll go through periods of despair and bubbles and bear markets. And that is a massive behavioral challenge and really difficult to encounter and experience on your own. It's difficult for professionals to do it, and certainly difficult for people who are not as au fait with the day-to-day fluctuations of and movements of financial markets. So it's a real challenge. So having someone to talk to about it, to help you understand that, is the best protection against making poor decisions during those difficult periods, and also helping you understand what information it's okay to ignore.
And is there an easy to understand way that people can think about managing their behavior when they're consuming investment information?
I think the best analogy is if you have a long-term investment approach, but you're poring over and obsessing over short-term financial market fluctuations. So you're worried about what happened in the stock market last week. You're worried about which fund outperformed or underperformed on any given quarter. You're very likely to struggle to meet your long-term objectives. It's a bit like starting a diet, but filling your kitchen with lots of chocolates and cakes. So you might still achieve your goal. You might still lose the weight you want to, but you're really making it very difficult for yourself. So if you want to achieve your long-term goals, you need to try and remove those distractions and try and make it easier to take a long-term approach and to make the right type of decisions.
Yeah, that's a great way of explaining that. Thank you. Is there anything I've not asked you about this topic that you think it's important for people to know?
Yeah, I think one thing to think about is it's like financial market news and information and economic information is interesting. I'm not saying that people shouldn't be interested and intrigued by it and fascinated by it, but there's a difference between something being interesting and something being meaningful in terms of your long-term investment objectives. So just because something is distracting, something is captivating, or you're particularly fascinated by how certain markets might develop over the next 6 months, or any issues around financial market developments, it doesn't mean you need to trade your portfolio or make changes to your asset allocation. So you need to understand and think about a way of separating things that are interesting and things that are actually material. Lots of things are interesting, not many things are material in building your portfolio. And one of the reasons we build diversified portfolios is because the future is inherently uncertain. There's a range of different unpredictable paths that it could take. Therefore, we hold a range of different assets that might do well and fare better in different environments.
Thank you. And just to wrap up, could you summarize in a few sentences what the problem is that we've been discussing, why it's important for people to know about it, and what they can do?
Yeah, absolutely. So one of the key challenges that we face as investors, particularly in this day and age, is we just have access to a huge amount of noise and information, and we also have an ability to trade quite freely as well. So that information provides a lot of stimulus for us to act. It's very easy for us to act and continually make changes to our investments or our portfolios. But that runs counter to all the good disciplines you need to be a successful long-term investor. So one of the key skills we have as investors and to be successful behaviouralists investors is to think of ways to avoid being too distracted by the noise and the information that we have to deal with on an hour by hour or a day by day basis. So I would say that the right prescription here is to try and reduce the amount of financial market information that we consume. It's okay not to check up on what markets have done every day. We also need to be clear about what matters. So what are the things that really influence the long run returns that we generate, and separate that from the short term vacillations of markets. And finally, find someone to speak to when you're going through periods where you're feeling an emotional response to financial market developments, when you're worried, when you're anxious, or even when you're excited about an opportunity or envious of someone else making money in a particular opportunity. Try not to react in the moment to that information. Take some time away from that decision, and also take the time to speak to someone who can give you counsel on how to make better long-term decisions.
Fantastic. Thanks very much, Joe, for talking about this today. I'm sure that's going to be really useful for a lot of people.
Not at all. Really enjoyed it. Thank you.